Manish Gunwani, the Senior Fund Manager at ICICI Prudential, joins us as the Market Master for the day. Good morning, Manish. Good to have you with us. Yesterday we had Rhythm telling us that, a one-year target could be even as big as 33,000 on the Sensex. That's, of course, a bull case. What are you looking at in terms of gains? Say 1 year or 2 years, whatever you're comfortable.
Well, Lala, we don't give targets, but I think the more important thing is if there's a bull market in the economy, we'll obviously have a healthy stock market. And it does look like we are heading into a sweet spot for the economy because we are heading into a phase where you have a lot of spare capacity and you have demand coming back, but there's a lot of latent demand as well. So what happens typically in that phase is when demand comes back with a lot of fixed costs already there in the system, the profitability in those sectors will be fantastic over the next 12 to 18 months. So I think we are in a healthy spot in that sense. And I think the market should reflect that.
Okay. Typically what should be the preferred sectors in the initial phase of the economy picking up? I mean, we have moved to a 5.7. Maybe we will stick with at least a 5% plus in the next 2 quarters because of agriculture not doing too well. But in these phases, should you go to industrials?
So I think that's a very interesting point that obviously there are early stage cyclicals and late stage cyclicals. We think the early stage cyclicals would be consumer discretionary, like auto ancillary, some of the banks. And you can see that the body language of a lot of these companies is much more positive today than it was, let's say, same time last year. So I think those are obviously the early stage companies, CVs also. I think the late stage would be industrials, property, etc. And I think it will hinge on how deep the cycle is. If we are able to sustain growth without too much of inflation and current account deficit, then I think we will move to the late stage cyclicals where they will start performing well. So if you look at numbers, auto numbers, etc., they've already done very well now. So I think the early stage cyclicals are in for a good time.
Okay. When you say industrials, you mean last into capital goods kind, metal?
So again, there's a spectrum in that. So you have some consumables which will again be early stage. Some of the bearings companies, for example, maybe. But yeah, the heavy capex companies would probably be late stage. But again, the valuation matters, right? If you're getting them cheap, they'd be interesting even now.
Manish, hi, morning. You were telling us in the break that Maruti is one of your top holdings in your portfolio and we have a lot of positive triggers over there. Would you just recommend sticking to passenger vehicle names only, or because of the revival in the commercial vehicle space, even some of the beaten down names, like Leyland, etc., look good?
So we don't specifically want to mention names, but broadly, I think auto and auto ancillaries is a great sector to be in because obviously you have a domestic recovery which for this sector can be pretty early because once the sentiments turn, people tend to purchase these items. But there's also a big export element for both auto and auto ancillaries, which could be very structural in nature. And the balance sheets are clean, the managements are reasonably good. So I think that's a great sector to be in broadly.
Okay. We have a lot more sectors to ask you, but our viewers get priority. They are allowed to ask you questions through our Money Control message board. So here's one that's come from Nipen Deka. He writes to us from Guwahati. There's your viewer all the way from Guwahati. He wants to know if he should invest in pharma stocks, and in specific he wants to know about Sun Pharma.
So again, we don't want to mention names, but we think pharma is again a great sector. So while we think the domestic economy will do well, we don't think rupee is going to appreciate much. So to say that IT and pharma will not do well while domestic cyclicals do well may not be correct this time.
Okay.
So I think within pharma, it's a very stock specific sector. You have to see the pipeline in US for each company, their domestic business, etc. So overall, we retain a fairly constructive view on that sector as well.
Okay. By far, the biggest positive cue that we have this morning is the way Brent has fallen. So 18-month low. And we're seeing all these oil marketing companies move up quite a bit. Given that things have improved substantially with respect to, under recoveries, etc., do you think even in the next leg of the rally, some of these oil marketing companies will dominate?
So again, I think hand of God has been kind on crude. So it's a great boost for the economy. I agree. I think energy again, if you see on a 10-year basis, these stocks look cheap because for many years they have not done anything because of reform issues. And I think there's a lot of more clarity on reform. I think diesel under recovery is almost gone now. So I agree that energy again is a very interesting space to watch.
Okay, let me ask you a risk-averse question. What would you do with fixed income at all now? There is a Reserve Bank governor who's at least gunning for 6% in the next 15 months. So is there a play in the fixed income in the long bond?
We think there's a fabulous play out there because with crude at this price. And I think if you see inflation, there are 2-3 elements which are in a sense one-off, right? In a sense, your currency depreciated a lot. So on a YOY basis, that effect will go out. There will be a lot of subsidy rollbacks, whether you talk about diesel, electricity, railway freight. Again, these are kind of one-off things we've taken over 12 to 18 months. So that also the effect will go off. So I think we have a very constructive view on long-term duration bonds.
Okay, but it's not always that you will have a bond buy and an equity buy. So, you know, what should be the split?
I think both assets will do well. Typically, if you have growth without inflation, I think both assets should do well. Now, again, in equities, you've seen a fabulous run. So maybe next 6 months, it could be a bit volatile. So I think it's very important for investors coming in now to have a 2-3 year perspective. One thing I'd like to mention is while domestically everything looks good, and so does internationally, but the international scene is always a risk on, risk off trade, which can always happen. So if you have a very short-term view, there could be some volatility purely because every market has done well, and typically that doesn't go on for a very long period of time. But yeah, from a 2-3 year perspective, I think there are healthy gains to be made in equities.
And what about the earnings targets? I mean, we ask this question to everyone, and we get a lot of, aggressive targets as far as Sensex earnings are concerned. Just 2 days ago, someone was talking about 20% earnings growth in FY16. What would your forecast be?
I'll give you something more fantastic if you remember. Doubling of earnings in 4 years.
In 4 years, yeah.
So that's what, 2,800 earnings. Then Sensex looks like 9 times.
See, again, when I was here last time, I said it's a very difficult to model earnings. So just if you see again auto, 3 months back, it would be difficult to say whether these companies would have double-digit growth. And already you're saying some companies have north of 20% growth. So I think directionally, earnings are going to be better than what a lot of people think. Okay. Quantifying is very, very difficult.
No, the reason perhaps we're asking you to quantify is to gauge where the highest beta will come in, as far as earnings performance is concerned. So sector-wise, where do you think the highest rebound could come through?
So again, I think that's very, very stock-specific, right? I mean, there are a lot of companies which have currency impacts. So if you see something kind of strange is happening, that the dollar is appreciating against developed countries, but it's not appreciating all that much against EM currencies. So you have to kind of calibrate all your models based on this. So for example, if auto company is importing from Japan and now the yen is at 105, I mean, that obviously is a tailwind as well.
So that explains why Maruti is 3% higher today. I mean, it's doing exceptionally well. Okay. Sorry, mellowed now. Started off with a bang though, the Maruti stock. How would you play the oil marketing companies now? Is the best over already in the price, or is the best yet to come?
No, I think there is juice left there. We do have exposure to that, and a lot of them are still below book value. So as I said, because of years of underperformance, because they've gone up recently, it may look heated up. But I think if you see on a long-term basis, the valuations are still attractive, especially relative to the market.
Okay. Well, what would the relative preference be, mid-caps or large caps? And if you can give our viewers some clue as to how you would pick mid-caps.
So I think today it's very balanced. I mean, 1 year back we were saying mid-caps look fabulously cheap, but today frankly both seem to be very balanced because obviously the mid-cap index has done really well. So today, I don't think we have a top-down view saying buy mid-caps over large caps. In fact, I would think on the margin, large caps are better than mid-caps today. Coming to mid-caps, I think essentially any stock picking boils down to trading three factors: valuation, business model, and management. So you have to kind of triangulate between that and kind of choose your stocks.
Okay. I was going through your note. It's interesting you point out that despite the gains in the equity markets and despite the valuations, you are cautiously bullish. Why that?
That's a cliche, isn't it?
Why that word caution? I mean, is it because the market has run up so much, or do you think that...
Exactly. I mean, see, valuations, while obviously if we get a good recovery, they're cheap and we think that'll happen. But two things. Well, let me say three things. One is the markets run up a lot. Two is there is some reasonable supply of paper coming up. So from next month onwards, you would see divestment kicking off, which is always, can create volatility. And three is, as I said, the global risk metrics are so low today that just as a contrarian, you think something can happen out there.
Okay. Well, we'll leave it at that, Manish. It was a pleasure speaking with you as always. Thank you very much for dropping
Thanks.
by.